Nick Nelson, market strategist at UBS, is here. Hi, Nick. Thanks for joining us today. A lot of the attention today, especially after Mario Monti's comments over the weekend, seemed to be on Spain. How worried are you that the spotlight now falls on Spain and its ability or inability to bring down that budget deficit?
Well, look, I think there's clearly problems in Spain. It's a little bit different from Italy. When you look at Italy, the problems are very clearly the government debt, the debt to GDP of over 120%. In Spain, it's much more the private sector. It's the banks, it's the housing market, it's the individuals. And that's why I think it's a bit murkier and harder to see where the real issues lie. So clearly, in recession, doing austerity, trying to tighten policy, it's going to be difficult.
We saw how far and fast bond yields fell, Nick, in periphery Europe. And in Spain, we went from almost 7% only a matter of months ago to below 5%. But now we're back on the 10-year yield to around 5.4%. Is it a concern? I know you're an equities man, but is it a concern for market sentiment that yields might creep back up post 6% and maybe towards 7% and the ramifications of that?
Well, definitely. I think some of the improvement we've seen since November, December time has clearly been brought about because of LTRO and general confidence in the markets. This has allowed Italian spreads and Spanish spreads over Germany to come down a long way. Now what we're seeing is just a little bit of a backup, specifically in Spain, as you highlight. We don't think this is a situation that's leading to another Greece, as it were, but it's clearly of the big economies the one that we're keeping our eye on the closest.
Has the equities rally run out of steam, Nick? I mean, last week, biggest weekly decline of 2012. Not only here, but in the United States as well. What did you put that down to?
Well, look, I think we'd had a very big move, a very quick move, with little consolidation. We'd suspect that you see some consolidation now. Some of the macro indicators, so last week the PMIs in China and Europe were a little bit weaker than expected, just dipping below 50 again in Europe. And I think that's the fact. We are in recession here in Europe. The US is looking a lot better, and the picture in China is reasonable, but not great.
And as I said, Nick, yields are rising, and that's not necessarily bad for equities, is it?
No, I don't think so. I mean, I think in the past, sometimes when you have a big rise in yields, people have assumed that that's a negative for the equity market. This time around, I think it's different. Firstly, we've seen equities move higher. Economic indicators since October, November moved broadly higher, and we haven't seen bonds move. So they've been left behind. So a little bit of a move up in bond yields wouldn't surprise us here.
The industries to avoid and the industries to go for, there's a bit of a delineation, isn't it? Yeah. Let's go for the ones who could be the winners, financials, for instance.
Definitely, and particularly insurance companies, and specifically within that, life insurance companies. So these are guys who have these very, very long duration liabilities, and as these bond yields rise, that helps them somewhat. It's the AXAs, the Aegons, the Allianzes.
You've removed Swiss Re from your key calls list, and you've added SCOR. Prudential remains a key call. Why have you removed Swiss Re? Any reason?
It just had done pretty well. It had gone close to price targets. SCOR's slightly more sensitive to higher bond yields. So that's kind of some of the themes we're looking at.
We'll get to your view of monetary policy and the overreaction. Just to finish off your theme about rising bond yields not being particularly bad for equities, insurers definitely an industry that could benefit, other financials as well, Nick. But on the flip side of the coin, which are the industries? Utilities, telcos, ones that might suffer?
Sure. So basically, it's the highly leveraged sectors, high net debt to equity. So the biggest, the most geared sector in the market is utilities. Then it's the telecoms, and then it's the transport sector. But it's particularly utilities and telecoms, and the regulated ones, the ones that kind of are bond-like equities, if you like. Some of those in Southern Europe, which have their own issues, and even perhaps in the UK.
Okay. I want to get back to the central bank theme. They're looking forward to central banks. Have they overreacted? Are their balance sheets becoming too big? What are the implications of those questions, which at one point markets and investors are going to have to think about? What are the long-term implications for equities because of those questions?
Well, look, I think they did the right things. I think they had to step in 08 and 09 and lean against the deleveraging we were seeing in the private sector. If they just stood back, it would have been like the 1930s. It would have been horrific. However, there are problems, and there's going to be difficulty in exit strategies. So it's all very well and good giving €1 trillion or so to the European banks for 3 years, but then they have to give it back in 3 years' time. So I think we'll look at the ECB, we'll look at the Bank of England and the Fed, and we'll see how do they exit this ultra-loose monetary policy.
Bill Gross overnight was tweeting, and he suggested that the Fed might in April hint at further QE, which goes against the thinking, doesn't it, in the markets, that after the after the comments earlier this month that they've raised their assessment of the economy, there would be no more QE. Do you realistically expect more quantitative easing in the US?
No, we don't think so. We think the economy is looking like a self-sustaining recovery now. The labour market in particular, which is always the last thing to recover, looks improving quite strongly. So we would argue that the Fed will be raising rates actually in the middle of next year, so ahead of this 2014 sort of target they've mentioned.
On the regional basis, which equity market, Nick, is looking more attractive? Parts of Europe, Europe as a whole, or the United States?
Well, our preference has been for emerging markets in particular, and then the US, and then the UK, with continental Europe right at the back. I mean, it is the cheapest market, but it has these issues, as we've been seeing and discussing, about Spain. And I think if we can get a bit more clarity on that and the firewall and Portugal, then Europe will recover.
Nick, thanks for joining us today. Nick Nelson, then market strategist at UBS.